Good morning, everyone, and welcome to week one of financial management. Today, we are going to go through a 30-minute to 45-minute PowerPoint slide of the very first chapter or first topic, which is basically what are financial statements and a little bit about the course. Now, when the idea of this is that you are watching this before you come to my live class. And then when we come to my live class, I may touch upon some of the things that we talk about here in this quick lecture. But then we'll get into like the syllabus, the assignments, and our first in-class activity. So I'll go ahead and start this PowerPoint slide. Oh, I'm sure you're okay with this. So as you can see here, a couple learning outcomes for this particular course. Now I have gone through these. I won't go through these in detail right now. Take a look at these when you have a moment. These are the things that you will want to know that you can successfully prove to be able to pass this course. But ultimately, we want to kind of ask ourselves, what is the importance of financial management? Why does it matter in our life? Why does it matter in our personal lives versus our business lives? And some of the questions that we want to answer or even ask ourselves are, in my business, where are my sales coming from? As an idea of a more specific question, what is the average selling price of my rooms this week? But this could also be, what is the average guest check of my restaurant? Or what is the average attraction or ticket price that I'm charging? We also want to look at so that's the revenue side. We also want to look at the cost side. So what are some of my major expenses? And how do I prepare and budget for a major expense? So for sure, in your other classes, we already looked at income statements. You kind of have an idea of what they are. You may forget some of the formatting and what they look like, but that comes back quickly. What the idea of this course is, how do you make changes and influence directional or budgetary changes within financial management? So also knowing, what is my company worth? Can I sell it and make money? When do I break even? So, Black Friday used to historically be one of those times when most retail locations start to break even for the year. That's why they call it Black Friday, because they're in the black. So in the black means you're making money on an income statement. In the red means that you are losing money. So Black Friday was kind of historically, as the Christmas season approached, that's when those companies said, okay, for the year, that's when we really start making money and being able to save money. So how this would apply maybe to our particular circumstance would be, as an example, in our industry, if we had a medium-sized hotel, would we be more profitable if we installed a pool and spa? Right? So we have to think about this. Now, during COVID days, pools and spas are usually a no-go, but usually what you'd ask yourself are some of these questions. What kind of costs are there for the labor and supplies and all the energy? Does our guest change? So now that we have a hotel with a spa and a pool, we'll probably get a higher level of guests, a little bit more higher class, and then therefore we can charge more revenue. Will that amount of revenue make up for the cost of the pool and the upkeep and everything else? How can we measure our success? What are our upfront costs? And if this didn't work, so this is a really good question. If we installed this pool, we installed the spa, and if it didn't work, we didn't see a huge increase in business, we didn't see a lot more money coming in, what do we do now? Right? You can't just fill it in and it's just a waste of money. So you got to start thinking, will the cost of this, if you weren't going to make money, would the cost of this somehow cripple your business and then therefore you'd have to close down? Now, there's always risks. So these are the kind of things that we want to break down, be able to think about, and come up with the financial evidence to say, I'm going to take this risk because of reason A, B, and C, and I know how much it costs me and I know what to do. So as a little bit of a review, there are 5 branches of accounting out there. We're only really going to deal with 2 of them. So financial accounting. So this is kind of where we are. This is the basic idea of recording financial statements to show and measure the success of a business. And we know this by looking at income statements, which is the first bubble here. So this is an income statement, revenue, all the money we make through sales activities, minus expenses, the money it costs to run our business, equals our profit. And then our balance sheets are very similar as well, or not similar, but you have seen this. This is all the stuff that we own, items or property owned by the business, subtracting all the liabilities. So these are all the debts and bills that the business owes. That gives us our owner's equity, or our equity, which is how much company is worth if we were to sell it today. Now, important thing to note, expenses and liabilities are different. Expenses are something that we must buy in order to make a sale. So we have to buy food in order to make a meal and sell it. We have to buy sheets and launder them and do all that kind of stuff in order to sell it. Whereas in liabilities, it might be the debts that we had to borrow money from the bank to build this business, and we have a monthly payment on that. Okay, so it's a little bit different. And then there's also cost accounting. So cost accounting specializes in the analysis of the cost of the business. So these take into consideration of all the potential costs a business may incur, and this also will help you come up with a proper pricing model. We'll look a little bit at this stuff as well. So if you had a resort with a golf course on it, how much do you charge for a green fee? What kind of things do you need to take into account? So what do you need to think about? How much water you use? What's the labor for maintaining it? There's the retail staff and the front desk, or the pro shop staff. All of those different things. So how much does it cost just to run that whole golf course for an entire year, let's say? And then you start breaking it down. How many rounds of golf do we need to sell to make sure we make money? And then another three that we're not really going to touch upon are tax accounting. So this is just how we do everything properly. This is typically why most of these businesses, we don't do taxes ourselves. We hire an accountant to do that. Same thing with auditing, dealing with assessing and verified business to make sure they're complying with all legal requirements. And then finally, managerial accounting, which I suppose that we do. And this is more of a day-to-day operation. So this could be ordering, pricing, your scheduling, the hiring, all the day-to-day stuff. So cash versus accrual. So this is pure review here, okay? So there are two methods, cash and accrual. The difference between these two methods is how and when sales, revenue, and expenses are recognized. And I don't remember if you understand or if you remember the terminology by recognize is when we actually record them and like the cash would come out or the sales would come in. So on a cash basis, which we typically don't work with, sales revenue is received when the cash is received. And same thing with operating, we don't record it as an operating expense until we pay it. We don't really in business, in the world, we don't work with that. We work on an accrual basis. So as an example, when we have finished the job, when it's earned, this is when we record it. So if someone pays me $500 in advance to plow their driveway all winter, I'm not recording that $500 until I'm done plowing the driveway for the entire winter. Or I'm saying, okay, it's 4 months and I'm taking $125 at the end of every month, which would equal $500 over time. So only when I earn it, and same thing with operating expenses, when they are incurred. So when we get the bill, that is when we record it, not when we pay it, because you can kind of fudge your numbers and it's not as accurate. So the thing that we will be looking at actually over the next couple weeks and doing a lot of different assessments with are these 4 financial statements. Now, I know that you have looked at these before. I know in accounting you looked at these, but what you looked at was probably a pretty elementary or basic look at an income statement. Now we'll look at income statements like we would in our own industries, where we have a resort with 3 restaurants, recreation activities, 2 little lobby bars or breakfast places, a golf course or a treetop trekking. So many different revenue centers that it gets more complicated. So in real brief, the balance sheet, which can also be called the statement of financial position, is the financial position at any given time. So on just January 5th or 6th or whatever it is today, you can look at that and see your financial position at that particular time. And usually what we do with balance sheets is that we look at them at the end of the month. Same thing with income statements. It's usually a monthly, although you can really get down and start looking at them weekly so you can make decisions on sales and scheduling and things like that. Income statements is also known as your P&L statement, your profit and loss statement. So this records your financial position in terms of net income, net loss over a specific period of time, month, quarter. So you often hear in Q2 and Q3 and Q4, there's 4 quarters in a year. These are the things that are reported. Cash flow statement, while technically not something that is seen as much, because usually when someone's looking at financial statements, they want to look at the balance sheet, the income statement, and the statement of retained earnings. Rather, the cash flow statement is basically how we pay for things. So this shows how cash changes not only from operating activities, but from investing and financing activities. Cash flow statements are very important because you might have a very successful and profitable business, but as an example, if you are one of our resorts that we often seem to work at, you're closed over the winter. If you have 3 months which you're unable to pay your bank bills, your heating, your hydro, and whatever salaried workers you have on year round, that's not going to work, and your business might fold. So cash flow statements say, okay, how do I make sure I have enough cash to pay for all the things, even during the off seasons or the shoulder seasons? And then there's a statement of retained earnings. It's also the statement of changes in equity. This details the movement in owner's equity over a period of time. So you're basically saying equity is your worth. So basically this is just saying at the end of this year, month, week, quarter, whatever it is, are we worth more money or less? And by how much? So we'll take a quick look at a balance sheet. So this is the balance sheet. So a couple things that you should need to know. They are broken down into current assets and non-current assets. Basically, the way that we look at these things, current assets are the most easily converted to cash, and they're considered short-term assets. So our current assets are inventories. We're going to use our inventory as we sell things. Our cash, because that's as current as it gets, or as liquid as it gets. And then these trade receivables, which is essentially money that's going to be paid to us within the next year. Our non-current assets, property, plant, and equipment, goodwill, intangible assets. These are some of the things that, they're going to be with the company for a long time. We don't have any plan on selling them. We're not going to just randomly every year or every couple of weeks sell our property and our equipment. They will be there a long time. Intangible assets, just so you know, it's kind of a funny term. Intangible means something you can't hold in your hand or touch. So these are brands, these are patents, these are trademarks, reputation, Apple, Tesla, Instagram. These are all brands that people kind of fall back on and that they support and are proud of. And because something has an Apple logo on it, you can charge now 3 times as much, right? So these are the things that have some value to them, even though you can't hold it in your hand. Next one, if my computer will work, is equity and liabilities. So like I said before, equity is what the business owes to its owners. So if the owners were to sell the business, how much would they get out of it? We calculate it by taking all of our total assets, which here is $265,000. We subtract our total liabilities, which here is where are liabilities? Down here, sorry, $100,000. And they give us the equity of $165,000, right? So total assets minus total liabilities equals equity. Share capital represents the amount invested by ownership, and this can be one person if it's a single owned business, or millions of people, such as an Apple, who have many people who have bought shares in that company. So they own a little small little part of that company. So you can see here, share capital, retained earnings, reevaluation reserve. And then retained earnings is a total that the income statement can and be a net profit or loss. This is how the income statement and the balance sheet affect each other, is by looking at the amount of retained earnings. So revaluation reserve is a surplus of any asset that is increased in value, such as property. So they're saying, we had a bunch of property, plant, and equipment. We spent $130,000 on it. We can't just say now this is worth $145,000, but what we can do is down here in equity say we got this reevaluated. It is now worth $15,000 more. So our property has went up. We didn't do anything as far as a business. That's just the gradual. Some things go up in value, some things go down in value. So this could be a negative as much as it could be a positive. Here they lucked out because housing prices and property prices usually go up. And then liabilities. So liabilities is an obligation that a business owes to someone, usually involving a transfer of cash or resources. So current liabilities are something that you will want to pay off within 1 year of incurring that debt. So anything over 1 year, like a car loan or a mortgage, is going to be a long-term liability. Current liability is within 1 year. So that's most things, that's your Rogers bills. And, even if you borrowed $50 off somebody and said, I'll pay you back in 2 weeks, that's a current liability. Long-term may take many years to pay back, such as car loans, mortgage, just like I said. And then trades and other payables are typically amounts owed to companies that you have purchased something on credit. So as an example, so they have a trade and other payable here for $35,000. So they didn't borrow $35,000 worth of money, but rather what they did is they used like a Cisco, which is a food company, as a restaurant, and they ordered $35,000 worth of food. And they will pay them back. But often what a lot of these companies do, they understand that we need the food to be able to make the meals, to be able to sell it to the customer, to get the money back. So they might give us 30 days before we have to pay for that food. And then we have 30 days in which to make that food into meals and get revenue and pay it back, right? So they just kind of have that. And it could be alcohol, it could be linens and water bottles, or it could be anything really. So the purpose of a balance sheet is identifying risks, helping identify trends in spending, and also helping with receiving any further financing and applying for loans. So if you were going to go in and apply for a mortgage, they want to see your personal balance sheet. So basically, how much are you worth? I know when I was in college, I was worth negative amounts of money. And many of you probably are, because even a car is not an asset because it's depreciating. It just is going down in value all the time. So when you look at this, you say, okay, if I went to a bank and showed them how much assets I had and how much liabilities, most likely as a college student, unless you're very well off or you have family money or something amazing, you would have a negative, and the banks would probably not feel great about lending you something. Now, that being said, they'll also take a look at your income statement and say, well, how much money do they make? So the income statement, it's probably the most important hospitality statement. It's what we'll look at a lot, and it shows us the money that we're making, right? So it shows us the revenue that's generated. So how much money do we come in? Now, revenue is money that comes in before that we pay for it, or we pay for the cost, right? So revenue is just one part of it. Then there are the expenses. So as an example, if I buy a bottle of wine for $10 and I sell it for $30, the bottle of wine is $10, that's my expense. The revenue is $30, but my net income is $20. The revenue minus the expense equals net income. Here you can see they have like a small landscaping company. So they're making about $20,000 in landscaping fees. And then they have the expenses. So they have commissions, they have auto expense, they have dues, insurance. Their expenses are about a little over $11,000. Therefore, their net income is $11,125. The revenue minus their total expenses equals their net income. And here's just another way of showing it, if it helps. Again, revenue also includes income earned from activities of the business, only earned when the work or the sale is completed. So just remember that. And the cost of completing the cost of sales is the cost of completing the work or sale. So for the sale of an item, it would be the cost of the inventory, as well as perhaps the production and the labor cost. So when you think about, I always look to restaurants because it's really an easy way to look at it, and where a lot of my experience comes from. If I sell a dish for $35, yeah, it maybe only cost me $10 in food in which to buy all the food, but then I also paid maybe someone 3/4 of an hour to prep it and cook it and prepare it and send it all out, and then all the other stuff that came with it. So here are some of the revenue and cost of goods sales. Revenue minus cost of goods sales gives you gross profit. So gross profit is basically all the profit before the next set of deductions, expenses. So as you can see here, we have this whole other set: other income, distribution costs, administration, other expenses, finance charges. Now the thing about this is all costs that aren't really related to the sale of that food, as an example, right? The cost of sales is the labor and the actual cost of food. This stuff is just business costs. Like, we have a business, and therefore there are other things that we have to pay. It could have been utilities, it could be property tax, could be all these different things that you can't really assign it to a revenue center, right? Like, you can't say, okay, this property tax, I'm going to assign it to my restaurant sales. Like, you don't need to have a property tax to sell food. So they're saying, okay, we have all these other things after our gross profit, which is how much we made from the sales of our activity minus the cost of sales. How much do we have left? Well, we got to deduct all this other stuff. So they have some other forms of other income, which could be investments, could be who knows what. And then they have some transportation, distribution costs, administrative expenses. So this could be marketing, this could be your HR department, printing, who knows. And then they have some generic other expenses, finance charges, that could be bank fees, things like that. Basically, works out to about $15,000. So their profit after tax is $40,000, and then the tax man comes and we have to pay tax. So here it's 12,000 on 40, and you get to keep as your net profit or income. Income and profit, those words are synonymous, which means they mean the same thing. You make $28,000. This goes more into detail about what these are. Again, I think you kind of get the gist of it. So what the purpose of the income statement is? It identifies changes in sales revenue and helps compare growth. So you see on a week-to-week, a month-to-month basis where your sales are coming from. Are you growing or are you shrinking? And we usually look at that as a percentage. So we'll say, like, we had 5% growth in sales, or we had 5% decrease in sales. Shows changes in gross profit and net profit areas. So this is also looking at your costs. So your gross profit and your net profit is all of your revenue minus all of your costs for net profit. So your revenue may have stayed constant, but you made less money. So obviously you're not handling your costs as efficiently as you were in a previous period. So those are some of the things you look at. And then you can also use this to compare to other competitors or determine the success of your business. We want to keep 30% of our revenue at the very bottom line of our income statement. And what might happen is you only keep 20%. So then you know that, okay, I wasn't quite as good as I wanted to be. This here is the Intercontinental Hotel Group income statement. This shows you Holiday Inn and Express, Crown Plaza, Regent, Intercontinental Hotel, the Hotel Indigo, and they have more. They have almost 1 million rooms. And these figures are all in the millions, okay, just so you know. 2016, 17, and then 18. So it's just kind of interesting to see what I'm talking about for trend statements or trend identification, where you can say revenue from fee business, $1.3 billion, $1.379 billion, $1.486 billion. You can see there's growth. Same here for revenue from owned, leased, and managed lease hotels. Boom, boom, boom. System fund revenues, reimbursement of costs. Now, you don't necessarily need to understand what these all mean, because unless you're running that company, it doesn't really matter. The revenue from their fee business is probably, a lot of hotels pay a franchise fee to have the Regent above their doors, just the branding and the name and everything. So I think they make a lot of their money from branding. This one here is some of the properties they actually own. This is system fund revenues. I couldn't tell you what that means, but they're obviously making quite a bit of money through that. And then they have their costs. So the costs of their sales, which is their food, which is their labor, which is all that cost, and it shows you how much. Their system fund expenses, which seem to be more than their revenues. Their reimbursed costs. They have all kinds of administration expense, and then some other stuff, depreciation, impairment, other exceptional items. A lot of this stuff here at the bottom, it's just, we don't know where that fits in. It could be 30 or 40 different items, and they just group it together for ease. And then they also maybe have some financial income or expenses. So financial income could be money they've invested and they're not making much, $6 million, and financial expenses, $86 million. They're spending a lot on their financial expenses. Anyways, it gives you an idea of what maybe more in-depth look at. This is a group income statement. So profit for the year from continuing operations. When we looked at it up here, we thought that they were doing better every single year. Like they just kept on having a bit of growth. If you look down at the final net profit, $459 million in 2016, $541 in 2017, and $362 in 2018, which just goes to show it's not necessarily all about the amount of money that you bring in, because these are all higher here than they are in the previous years, but it is how you handle your expenses as well. Okay, and the final one is the statement of changes in equity. So I don't know if you know this, but as a business, you have an option of choosing what kind of ownership you are. As an example, I have a mosquito spraying business that I do in the summertime. I would consider it a sole proprietorship. It's a single owner. There's a statement of changes in owner's equity. You also can have a partnership. So this could be several partners, but it has to be at least two people. This is called the statement of change in partner's equity. So instead of owners, it's just partners. And these are not public companies, which means these are privately owned companies. You can't buy a share on the stock market of them. They're just companies that are out there, and it's most of them. And then for a corporation, which is much different, you purchase shares from many different sources. So I can go on my TD Bank and I can just purchase a share of Enbridge or Apple or Facebook or whatever I want. And I will become an owner or a shareholder. And then this form is called the Statement of Changes in Shareholders Equity. Not a big change between all of them, just what we're calling it. Sole proprietor is one owner, partnership, many partners owner. Oops. And then people who buy shares, there's a shareholders equity. So the statement of changes in shareholders equity is basically the owner's investment, the income of the business, and then also if the owner took any money for themselves. So this is most often used for smaller business, and this is what it would look like. So the owner invested $10,000 of their own. They made a net income of $180, not a very good year, it seems like, and they withdrew $100 of that for something. So therefore, they are worth $10,080 over the year. And then this stuff. So we'll talk about this a lot. And the reason I'm kind of hesitating on talking about this is you're going to watch these next 4 slides and you might not understand it that much. And that's okay. We will work on this slowly. But we do have to understand how people invest money. What are stocks? What is a stockholder's equity? What is the difference between a cash dividend and a stock dividend, or what is even a dividend? So these are things that we need to know. I go through it briefly here, but we'll definitely work on it throughout the semester. So if you're still a little confused, don't be too worried about it. So This is a stockholder's equity or a shareholder's equity, so similar. This is the one that you would have used for an owner's equity or a partner's equity, perhaps. This is the one that you use for a stockholders or shareholders, just meaning it's a public company and a lot of people own a little piece of the pie. So, as an example, AMC, it's a movie company out there. It's like a Cineplex for Canada. AMC is the big one in the United States. They have 4.6 million owners because 4.6 million individual people have purchased a couple shares. So that's why it's a little bit different. So stockholders' equity is when you take all the company's assets minus the liabilities, and what is left is the equity. And for a company that has stocks, it is called the shareholders' equity. This form can help you make financial decisions, measure how well you run your business, and just maybe help you through some difficult times. Okay? A stock is a term defining a portion of a company, such as a share. Investors typically purchase the stocks with hopes of the value increasing or dividends being distributed to ownership. Honestly, that's the two ways, and hopefully you can have both of them. So if I buy one share of Enbridge, so Enbridge is our gas, and usually most of us are heating our homes through Enbridge. If I buy one share of Enbridge and it costs me $1 this year, I hope that next year it's worth $1.05, $1.20, $2. So that is a way that we can get growth. Also, and I'll talk about it in just a minute, they can pay you a dividend, which is basically a bonus of being a stockholder. And I'll show you in a minute how that works. A common stock is the amount set by the company for the value of their shares. Has nothing to do with market value. So the common stock par is $1. So when I first started the company, I said, okay, we have our company is worth $20 million. So let's go $20 million. We have 20 million shares and they're all worth $1. And then as we grow and we become more successful and things do well, our company is now worth more money. Okay, so that $1 par value, it's not worth $1 anymore. So the paid in capital in excess of par being 1, in excess of par is what it's worth more, is now worth 25 million. So this is the amount paid by investors for the market value of the stock. It's the difference between common stock par, and the market value, which is the market value here. A couple other things are retained earnings. So retained earnings is this column, but basically what retained earnings are is that a company will make lots of money in a year. Now, what they can do with that money is that they can pay it to their ownership. So it could be themselves, it could be any of their shareholders. But usually what they do is that they hold on to some of those earnings. Just because they might have some costs coming up. Maybe they need to buy new vehicles or buy a new piece of property, or they need to invest in new technology. Who knows what it is, right? There's lots of things a company might need available cash to do. So retained earnings is them holding on to some of that money for future investments. A treasury stock, so this treasury stock is basically the company saying, I'm going to purchase some of my own stock back. So I went out and sold a bunch of stock out there, right? I sold a bunch of my shares and people bought a bunch. But, I have some money. I think my company's doing really well. I don't see anything more attractive as an investment, so I can purchase my own stock back. When companies purchase their own stock back, it's usually a very good sign. When companies are selling a lot of their own company stock, it's not necessarily a bad sign, but it can be. They might be just trying to gather some money so they can expand or do something, or the ship could be sinking and they're trying to get as much money out of it as possible. And cash dividend and stock dividend. Okay, so before I said there are reasons why people buy into a stock, one or into a company, and they buy shares in that company. One of which is that they hope the value of their individual share goes up in money, right? They bought it for $30 and they sell it down the road for $40. They made $10. They're happy. Life is good. But what also can be done is that they can also pay you a dividend. So some stocks are what we call growth stocks and are just stocks that we think are going to go up in value, like all the Bitcoin ones and all the cryptocurrency and stuff like that. Other ones are dividend stocks who they might not go up in value, but they pay you a dividend, which is a percentage of the value of your share. So Enbridge, as an example, will pay you 7% of the amount of money you have invested every single month. So every month, if you put $1,000 into Enbridge, they'll give you $7 a month every single month. So over 12 months, 12 times 7, you make a fair amount of money. What would that be? $84. You make $84. Now, the share price might not go up too much, but you made $84 just sitting there and doing nothing. So here you can see they had to pay out some cash dividends to some of their shareholders. So this is a negative amount of money. And then they also have stock dividends. So sometimes instead of specifically owners and management and things like that, instead of them paying cash, they give them more shares of the company. They're pretty much the same amount. They have the same value to it. Just one's in cash in your hand and one's in a share of a company. And then this right here, I just want to show you, this is Cineplex. Now Cineplex, this is in 2019. And the reason I pull this one up, because this is a stock that is now worth about $11 a share. So back in the day, though, I used to own this, and I bought in, I don't know, probably around $25 or so. But it shows you all this information, and we can look at a bunch of these. But this says, okay, our previous close, which is yesterday, so every day there's an open and a close. Our previous close was $33.90. It opened at $33.94. In the day so far, and this is around 4 p.m., it went up 12 cents, which is 0.35% of a gain. So you went up just a little bit. It can tell you what the day's range, so if it goes up and down, and the 52-week range. So at the lowest point 52 weeks ago, it was $22. At the highest, it was $34.39. So we're pretty close to that highest amount. Some of this is the volume of how much people are sharing, or buying. So people are, on average, buying or selling 382,000 shares a day, on average. So it's busy. The market cap is basically the market capitalization, which means if the company has so many shares out there, and they're all right now worth $34.02. If they were to sell every single share, they would be worth $2.2 billion. It's basically what is the company worth right now? And if you were to look at something like Apple, it'd be outrageous. We can get into all this kind of stuff later on, but basically this forward dividend and yield, they're giving you 5.31%. So that's your dividend. So every month you get 5.31% of $34, which is $1.80. So they're telling you this is the cash amount, this is the percentage amount, and the next dividend payment date, which is on this, is December 30th. So it might not be every month, it might be every 3 months. It all depends. So this gives you an idea of what a share in a stock look like and how you read some of the very basic information. And ideally what you want to do is that you want to buy some shares in companies. This is how people invest your money. Mutual funds are made up usually just of a bunch of different companies like a Cineplex. And you want to make your money make money for you. And that's ultimately, in our industry, since we don't have these pensions and we don't have all of these great benefit packages and all the things that sometimes we miss out on, we need to figure out how to make money for ourselves. And I hope I can talk to you a lot about this throughout the semester and have a little fun with it. So that being said, I'll probably stop it here. When you see me in class in just a few minutes, hopefully you're watching this right before class, what we'll be doing is that we're going to just go over a little bit more of that layout. I'll show you some of the syllabus stuff, and then we will go into what the first assignment will look like and the first week's portion of that assignment. Until then, Happy New Year, and I will see you soon.